Welcome to the deep dive. We're here to really break down complex information, make it crystal clear for you. And today is absolutely mission critical. This deep dive is specifically for you, the loan officer grinding away, preparing for the SAFE exam. We know your goal isn't just passing, it's mastery. It's hitting that perfect 100 out of 100. And achieving that, it demands absolute precision. It demands what we call textbook fidelity, knowing the material cold exactly as it's laid out in your sources. So, our objective today: to pull out the most critical knowledge, shine a light on those tricky distinctions, and flag the facts you absolutely cannot miss. Everything we cover comes straight from the source material you're studying. This isn't just a review session. Think of it as a strategic breakdown. We want you walking into that test completely confident, ready to ace it. We're about to get into the nitty-gritty of mortgage programs, lending guidelines, all the stuff that could trip you up on the exam.
What's really foundational here, it's understanding that the whole mortgage lending world, especially how it's tested under the SAFE Act, it's all built on very specific rules and regulations. And these aren't just arbitrary rules. They have a vital purpose. Protecting consumers, yes, but also shoring up the whole financial system. For your exam, getting these nuances isn't just helpful. It's non-negotiable if you're aiming for that perfect score. So today, we'll navigate the core regs, starting with the ability to repay Rule ATR and its partner, qualified mortgages or QMs. Then we'll get into conventional loans, explore the government-backed options, FHA, VA, USDR, HS. And, to really get why things are the way they are now, we'll touch on those historical guidances that sort of pave the way for today's laws.
Okay, let's start right there, at the bedrock. Because understanding why these rules exist really helps make them stick, doesn't it? You probably remember, or at least learned about, the lending boom before the 2008 crisis. It was a wild time, right? Loans were being handed out, sometimes without really checking if people could actually pay them back. And the fallout from that, well, it led Congress to step in and fundamentally change the game. They brought in laws that forced lenders to actually assess a consumer's ability to repay before giving them a mortgage. A huge shift. It went from borrower beware to more like lender must verify. And a key part of this whole new structure was the idea of a safe harbor for lenders, basically some legal protection if they make loans meeting specific criteria. Those loans, qualified mortgages.
Precisely. And the CFPB, the Consumer Financial Protection Bureau, got the job of putting the details into rules, which ended up in Regulation Z. The Qualified Mortgage Rule, the QM rule, went live in January 2014, and boy did it shake things up. It's really important for you to grasp that a lot of lenders, even now, they strategically choose to originate only QMs. Why? For those liability protections. It's a straight-up business decision based on the rule. So what is a qualified mortgage? Fundamentally, your source material nails it, verbatim. A qualified mortgage is defined as a closed-end loan that adheres to specific product features and underwriting standards intended to ensure the creditor has thoroughly assessed the borrower's repayment ability. Don't just memorize that definition. Understand it. It's the blueprint for safe lending, moving away from the free-for-all to a structured approach. Getting that why behind it will definitely help you on the exam.
Okay, definition locked in. Now let's break down the specific product features a loan needs to have to be a QM. Precision is key here for your exam. Every little detail counts. First, payments. The regulation itself, 12 CFR 1066.43 AD, if this tankens, and I quote, "The periodic payments must be sufficient to cover the principal and interest, ensuring no negative amortization occurs." That's a huge one. No negative amortization. The loan balance can't go up because interest isn't being fully paid. See negative amortization, big red flag, generally not a QM. Then, building on that, the rule says, the loan terms cannot permit the borrower to defer the repayment of the principal, such as in interest-only loans. So, no interest-only periods, generally speaking. That's a direct contrast to some non-QM loans. Keep that distinction clear. Next up, the loan cannot contain a balloon payment feature, although some limited exceptions exist. We'll touch on those rare exceptions later for small creditors, but for your standard general QM, no balloon payments. If it's got one, probably not a general QM. Then, a simple one, but easy to forget. The loan's term cannot be longer than 30 years.
Straightforward, but don't overlook it under pressure. And this is critical, the fees. The total points and fees must not exceed 3% of the total loan amount, with some exceptions for smaller loans. That 3% is the general rule. We'll dig into the tiered system for those smaller loans very soon. Finally, the APR check. The annual percentage rate APR must not surpass the applicable APR threshold. APR is the average prime offer rate. It's your benchmark. Understanding how the loan's APR compares to the APR is absolutely essential for QM status.
All right, so those are the product features. Now let's look at the underwriting standards. What does the lender actually have to do to assess repayment ability for a QM? Again, 12 CFR section 26.43E is our guide. It requires, quote, A thorough assessment of the borrower's repayment ability, verifying income and employment using reasonably reliable third-party documents as required by the ability to repay ATR rule. A key phrase there. Third-party documents. Lenders can't just take the borrower's word for it. Verification is absolutely paramount. Now, calculating the monthly payment, especially for adjustable rate mortgages, gets specific. It involves the, quote, calculation of monthly payments based on the maximum interest rate that could apply within the first 5 years of the loan, measured from the date of the first periodic payment. That's designed to prevent that early payment shock.
Right.
Makes sense. And following that, the payments must be, quote, periodic payments structured to repay the outstanding principal balance over the loan term after the interest rate adjusts to its maximum during the first 5 years. End quote. So it has to stay fully amortizing, paying down principal even at that highest potential rate in the first 5 years. Beyond payments, underwriting needs, quote, verification of the consumer's current or reasonably expected income or assets as mandated by the ATR rule. Again, back to those reliable third-party docs. And naturally, lenders have to perform a, quote, calculation of the consumer's total current debt obligations, including any alimony and child support, get the full picture of their debts. Finally, they must do a, quote, calculation of the consumer's monthly debt-to-income DTI ratio. Now, here's a potential trip-up point for the exam. While the DTI must be calculated for general QMs, there's no specific hard cap, no mandated DTI limit in the rule itself for these loans.
Oh, okay. That's a common misconception then.
Yeah, it really is. Lenders have some flexibility there, which is a key feature of general QMs.
That DTI flexibility leads us right into another really nuanced area, the points and fees threshold. This is prime exam territory, folks, so let's really focus. We mentioned the general 3% cap, but the CFPB realized that for smaller loans, a strict 3% cap could cause issues, maybe even make those loans unviable. They wanted to prevent what the preamble to the rule actually calls anomalous results near the edges of the tiers. So they set up a tiered system. For 2025, for instance, if the loan is $134,841 or more, it's that 3% cap. But if the loan is, say, between $80,905 and just under $134,841, it's not a percentage, it's a flat dollar cap, $4,045, and it keeps changing. For loans under $16,855, the cap can actually be 8% of the loan amount. The takeaway here isn't necessarily memorizing every single number right the second those figures get adjusted. They'll be in your study guide. What's critical for the exam is understanding the concept of the tiers, why they exist, and the logic. As loan amounts go down, the allowable points and fees might be a higher percentage or a flat dollar amount. You absolutely need to review the specific tiers and those exact cutoffs provided in your materials. Pay close attention to the greater than or equal to and less than language.
Okay, with those fee thresholds clear, let's talk about the big payoff for lenders, the presumption of compliance. This is the heart of the safe harbor concept. It's a big deal legally, as your source says. Lenders who originate qualified mortgages receive a presumption of compliance with the ATR rule. But, and this is absolutely crucial for the exam, there are two distinct types of presumption. You have to know the difference. First, the conclusive presumption of compliance. This is the strong safe harbor. It applies to, quote, qualified mortgages that are not higher priced covered transactions. What that means. If a QM isn't higher priced, it's definitively considered compliant with ATR. It becomes incredibly difficult for a borrower to sue the lender later, even if they run into trouble. It's a very strong shield.
Okay, almost ironclad.
Almost, yes. Then there's the rebuttable presumption of compliance. This applies to, quote, qualified mortgages that are higher-priced covered transactions. Here, the loan is presumed compliant, but, and here's the key, the source material says, quote, a borrower can challenge this presumption by proving that the creditor did not make a reasonable, good-faith determination of their repayment ability, showing that their income, debts, and loan payment would result in insufficient residual assets. So, the big difference for your exam. If a QM is higher priced, the safe harbor isn't absolute. The borrower can challenge the lender's ATR assessment. This means lenders need to be extra careful with their ATR work on these higher-priced QMs, because that potential for challenge exists.
Got it. Conclusive versus rebuttable. Huge distinction. So we know what makes a QM, the features, underwriting, fees. Now let's clarify the scope. What loans does the QM rule actually apply to? And maybe just as important, what's excluded? Another favorite exam area. The rule itself, 12 CFR section 026.43b, applies to covered transactions. And how are those defined? Quote, closed-end consumer credit transactions secured by a dwelling, including principal dwellings, second homes, and investment properties. So think your standard mortgage, right? A loan for a fixed amount, it closes, it's secured by a house, a condo, maybe a vacation home or rental. But the exclusion list, you need to memorize this. It's a common source of trick questions. The rule explicitly states, quote, The rule does not apply to open-end home equity lines of credit, HLOCs, mortgages related to timeshare plans, reverse mortgages, bridge loans of 12 months or less. See a question about an HLOC or reverse mortgage? Immediately think, QM rule doesn't apply directly. Knowing that list code will definitely save you points on the exam.
Building right on that, let's break down the different types of qualified mortgages. It's not just one single definition. Each category has unique criteria. Crucial for your understanding. First, we have the general QM. We've touched on this already. For a loan to fit here, its APR can't exceed the APR by more than a certain percentage. And that percentage, it varies. It depends on the loan amount, whether it's a first lien, a manufactured home, a subordinate lien. For example, for first liens, the APR can't be more than, say, 2.25% over APR for loans above a certain size, like $134,841. That spread gets wider for smaller loans. You'll need to check your materials for the exact current thresholds, but the key concept is that APR to APR relationship. Underwriting-wise, for general QMs, remember, for APRs, they use the highest rate in the first 5 years, protects against payment shock, and critically, they must verify income, assets, but not dwelling equity for this, debts, alimony, child support, DTI, all using third-party records. That's non-negotiable. But remember the flexibility point. No mandated DTI or residual income limits for general QMs.
Though, lenders still need written policies on how they consider these factors. That mix of strict documentation and flexible limits defines the general QM.
Okay, now for a really interesting one. Seasoned QMs. This is where a loan can actually become a QM over time. It can gain that powerful conclusive presumption after a set period, but only if it meets some very, very strict rules. So what does it take? Well, the loan has to meet certain product restrictions right from the start. It can't exceed the points and fees limits. It needs to meet general underwriting rules, and this is key. The creditor generally has to hold it in their portfolio for the whole seasoning period, with very few exceptions for transfers. And finally, it has to perform well, meet specific payment standards by the end of that period. Let's nail down those product restrictions because they are super strict and vital for the exam. To even be eligible for seasoning, the loan must be a first lead. It absolutely must have a fixed interest rate. Okay? This means ARMs, step rate loans, they are not eligible to become seasoned QMs. Critical detail. It also needs regular, substantially equal, fully amortizing payments, no negative amortization, no balloon payments allowed. Term can't be over 30 years. It can't be a high-cost HOPA loan, though interestingly, higher-priced mortgage loans can become seasoned QMs. And of course, it has to meet that standard QM points and fees limit, usually 3%. There's also a newer exception related to changes made during temporary payment help for disasters or pandemics. Now, the seasoning period itself, generally, it's 36 months, starting from the first payment due date. That clock can get extended if the borrower is 30-plus days late at the end of the 36 months, or paused if they get temporary payment help for a disaster or pandemic. And the creditor. They generally have to keep the loan on their own books for that whole 36 months. There's only one transfer allowed, and even then, it can't be part of a securitization. And finally, loan performance. How well did the loan behave? By the end of that seasoning period, the loan must have had no more than 2 delinquencies of 30 days or more, and crucially, no delinquencies of 60 days or more. And watch the definition of delinquency here for the exam. It means missing a periodic payment covering principal, interest, and escrow by the due date. Late fees don't count for this specific performance test. A payment counts as 30 days late if it's not paid before the next payment is due. These performance rules are very specific, very testable. They show the loan proved itself over time.
Right. Shifting gears now to another specialized type, small creditor QMs. This category is carved out specifically for smaller banks and credit unions. How do we define a small creditor? 2 critical parts, and you need both for the exam. First, their assets have to be less than $2 billion at the end of the prior year. That number gets adjusted annually. And D, second, the creditor and any affiliates combined can't have originated more than 2,000 first lien recovered transactions in the preceding year. Both criteria must be met.
Okay, assets and origination volume, got it.
Exactly. And these small creditors, they get to originate 2 special kinds of QMs. First, small creditor portfolio QMs. These loans must have no negative amortization, a max term of 30 years, and meet the usual 3% points fees cap. Underwriting. Based on a fully amortizing schedule using the max rate in the first 5 years. Also, it can't be subject to a forward commitment, meaning pre-sold before closing. And critically, the small creditor has to hold onto the loan in its portfolio for at least 3 years after closing, with only limited exceptions, like selling to another small creditor or due to mergers. That portfolio holding is key. Second, and this is pretty unique, Balloon payment QMs. These are QMs made by small creditors who operate primarily in rural or underserved areas. Besides meeting standard QM rules like no neg am and 30-year max term, these must have a fixed rate and a term of 5 years or more. The creditor must also hold the loan for 3 years, again with limited exceptions. And to even make these loans, the creditor needs to have originated at least one first lend loan in a rural underserved area in the prior year. This is a super important distinction.
These are the only QMs allowed to have a balloon payment, and only under these very specific small creditorial conditions.
Okay, that covers a lot of QM ground. Now let's talk about non-conventional QMs, specifically FHA and VA loans. How do they fit into this QM picture? Dodd-Frank actually specifically told HUD, which runs FHA, and the VA to define what a QM looks like for their loans. They had to align their government-backed programs with the broader QM framework. So for FHA qualified mortgages, HUD basically grants QM status and that safe harbor protection to its single-family loans if they meet two main criteria. First, the regulation states, quote, "The APR does not exceed the APR by more than the sum of the annual mortgage insurance premium, MIP, plus 1.15 percentage points." That's a unique FHA calculation, factoring in their specific insurance costs. Second, the loan has to meet the general QM points and fees limit, usually 3%. But here's a critical carve-out, a very common exam question point. Quote, "For the purposes of this calculation, the upfront mortgage insurance premium, UFMIP, is not included in the points and fees total." That exclusion of UFMIP from the points and fees test, that's a fundamental detail specific to FHA QMs. You absolutely need to know that exception.
That's a huge one.
Definitely. Then we have VA qualified mortgages. The VA took a much simpler route, really. The regulation clearly states, quote, "The VA has determined that VA guaranteed or insured loans made in compliance with VA standards are considered safe harbor qualified mortgages, granting them a conclusive presumption of compliance with ability to repay rules."
Long that forward.
Exactly. It's in 38 CFR section 36.4300(b)(2). Basically, if a VA loan meets VA's own rules, boom, it gets that conclusive presumption. It simplifies things a lot for lenders working with VA loans. Now, there are some special rules for VA refinances, the IRL's interest rate reduction refinance loans, like needing to recoup fees within 36 months. But for standard VA purchase loans, that conclusive presumption, if compliant with VA standards, is the main thing to remember.
All right, so we've thoroughly mapped out the QM landscape. But what about loans that just don't fit? Loans that fall outside those QM boxes. Those are our non-qualified mortgages, or non-QMs. There's no official definition per se, but generally, think of a non-QM as a closed-end loan that doesn't meet one or more of the QM product feature or underwriting requirements. And they definitely exist. Understanding them is part of the full picture. So who typically gets a non-QM loan? What's the borrower profile? Often it's folks who can't quite meet the strict DTI or maybe the APR limits for a QM. This could include non-prime borrowers, maybe someone with a lower credit score, or a more complex employment history that makes QM underwriting difficult. Self-employed borrowers, or those with seasonal income, often find themselves here. It can be tough to document income consistently and to satisfy those QM DTI calculations. And sometimes a borrower just needs a product that's specifically not allowed under QM rules, like an interest-only loan or maybe certain types of balloon mortgages, because those structures fit their specific financial situation better.
Okay, so different needs, different profiles, but what about the rules? Do lenders just get a free pass on underwriting?
Absolutely not. And this is probably the single most important point about non-QMs for your exam. Non-QMs still must comply with the ability to repay rule. Just because it's not a QM doesn't mean the lender can ignore whether the borrower can actually afford the loan. They absolutely must still perform a detailed ATR analysis. The big difference, they don't get that QM safe harbor protection. The lender takes on more risk. So the underwriting for non-QMs involves a detailed look at repayment ability. They verify income and assets with third-party records, just like QMs, but they specifically exclude the value of the house itself from the asset calculation, payment calculation. They have to use the fully indexed rate and a fully amortizing schedule, considering the lifetime rate cap, not just periodic caps. For specific non-QM types, if it's a balloon loan, they have to assess the ability to make that big balloon payment, especially if it's higher priced. Interest only. They have to figure out if the borrower can handle the fully amortizing payments after the IO period ends. Negative amortization loans, less common now, require assessing ability to pay based on the increased balance after neg am.
And if there are simultaneous loans, like piggyback seconds, they have to evaluate the ability to pay all known loans on that property. The key difference is flexibility. Lenders have more discretion with DTI, residual income, credit history compared to QM. But again, that discretion comes with more risk for the lender because there's no safe harbor shield.
Right. Okay, so that covers the QM non-QM divide, which stems from those post-crisis rules. Let's zoom out a bit now to the biggest category overall, conventional mortgages. This is probably what most people think of when they hear mortgage. The basic definition, super simple. A conventional mortgage is any mortgage that is not insured or guaranteed by the government. So if it's not FHA, not VA, not USDRHS, it's conventional. And these mainly fall into two buckets, conforming and non-conforming.
Exactly. And that brings us naturally to conforming mortgages. These are often seen as the standard, maybe the prime conventional loan. Why conforming? Because they conform or adhere to the specific loan limits and the pretty strict standards set by Fannie Mae and Freddie Mac. You know them as the GSEs, government-sponsored enterprises. They are huge players because they buy these conforming loans from lenders. And that ability to sell the loan to Fannie or Freddie, that's a massive benefit. It generally means lower interest rates and costs for borrowers.
Because it frees up money for the lenders to make more loans, right?
Precisely. Keeps the capital flowing. So these loans have to hit specific maximum loan amounts, meet down payment rules, and pass through Fannie and Freddie's rigorous underwriting guidelines. And speaking of those maximum amounts, the conforming loan limits, you absolutely need to be familiar with these for the exam. They change annually, but let's talk about the structure using the 2025 numbers. For a standard one-family property, the baseline limit is $806,500. But in designated high-cost areas, that can jump way up to $1,209,750. And the limits go up for multi-unit properties. Two-family baseline is $1,032,650 up to $1,548,975 high cost. Three-family baseline $1,248,150 up to $1,220,150 up to $2,326,875 high cost. Plus, there are special higher baseline limits for places like Alaska, Hawaii, Guam, U.S. Virgin Islands, $1,209,750 for one unit there. Now, don't get bogged down trying to memorize every single one of these numbers right this second. The key for your test is understanding the structure, the baseline limit, the high-cost area adjustment, and how it increases for 1 to 4 unit properties. Check your study guide for the exact current numbers you'll need. Absolutely. Beyond the limits, there are other general requirements for conforming loans that are definitely testable. Let's start with the down payment. For a really well-qualified borrower, it can be as low as 3%. But if the down payment is less than 20%, meaning the loan-to-value, or LTV, is over 80%, then you usually need private mortgage insurance. PMI. PMI's purpose. Simple. It protects the lender and the GSEs if the borrower defaults. Reduces their risk. And the Homeowners Protection Act, HPA, is key here. It dictates when PMI must be canceled for loans closed on or after July 29, 1999. Two main triggers. First, quote, borrower request at 80% LTV of the original property value if the borrower requests cancellation. Second, quote, automatic termination at 78% LTV of the original property value. Termination is automatic. Got that. Borrower can request at 80% and must automatically terminate at 78%. Now here's a classic exam track. Quote, the HPA does not apply to FHA or VA loans.
Ah, okay. HPA is for conventional PMI only.
Exactly. Remember that distinction. Now, income qualification, documentation varies. Salaried hourly. Usually need pay stubs for 30 days. W-2s for 2 years. If commission is over 25% of their income, might need up to 2 years of tax returns to show it's stable. Self-employed, meaning 25% or more ownership in a business. Need personal and often business tax returns, typically for 2 years. And here's a detail to flag. Non-taxed income, like Social Security, it, quote, may be grossed up by 25%, multiplied by 125%. So if $1,000 in Social Security might count as $1,250 for qualifying. That's a common calculation point. Good to know. Definitely credit scores. Typically need minimums in the 620-700 range for conforming. Then seller concessions. Limits on how much the seller can kick in for closing costs based on the down payment. Know these percentages cold. Quote, less than 10% down. Concessions limited to 3% of the sale price. Quote, 10% to 24.9% down. Concessions limited to 6% of the sale price. Quote, 25% or more down. Concessions limited to 9% of the sale price.
3%, 6%, 9%. Got it.
Perfect. Finally, hazard insurance. Fannie Mae wants coverage equal to the lesser of two amounts. Quote, 100% of the insurable value of the property's improvements, or, quote, the unpaid principal balance of the mortgage, provided it equals at least 80% of the improvement's insurable value on a replacement cost basis. Just understand that lesser of concept.
Okay, that covers the main requirements. Now, how do lenders actually assess the risk? Let's talk underwriting and risk for conforming loans. They heavily rely on automated underwriting systems, AUS, you'll hear the names. Fannie's DUDO, Desktop Underwriter Originator, Freddie's Loan Product Advisor. These systems crunch the numbers fast, give an initial thumbs up or thumbs down, or maybe a request for more info. But lenders don't always just go by the AUS, they often add their own stricter rules on top. We call these credit overlays. An overlay might mean they demand a higher credit score than Fannie requires, or a bigger down payment, or a lower DTI. It reduces the lender's risk, sure. But here's a subtle point for the exam. Using overlays too much or inconsistently could actually increase the lender's risk of fair lending complaints. It's a tricky balance. Then there are loan level price adjustments, LLPAs. Think of these as risk-based fees. If a loan has characteristics the GSEs consider higher risk, there's an LLPA fee, and that fee usually gets passed to the borrower as a higher interest rate. Critically, LLPAs are cumulative. Multiple risk factors can add up. That's factors. Things like the loan term, the loan balance, property type, investment property usually has higher LLPAs, transaction type, like a cash-out refi, and definitely the borrower's credit score and LTV. Let's use an example from the source. $100 K loan, LTV between 75–80%. A borrower with a great 740 plus score might pay a 0.5% LLPA $500, but a borrower with a 620 score, same loan, same LTV, could face a 3% LLPA $3,000.
Wow, big difference.
Huge. It shows exactly how credit score impacts the actual cost of the loan because of these risk adjustments. Understanding LLPAs and what drives them is key for your exam.
And sticking with risk and the GSEs, we need to talk about loan repurchasing. This is a big deal for lenders. If a lender sells a loan to Fannie or Freddie, and later on, that loan is found to have defects, meaning it didn't actually meet the standards the lender promised it did, the lender might have to buy that loan back, repurchase it. That can be incredibly costly for the lender. So the GSEs have a whole remedies framework to handle these defects. You should know the categories. First, minor issues are just called findings. No real penalty, the loan was still eligible. Then, price-adjusted loans, PALs. This happens if there was a defect that should have triggered an LLPA, but the lender didn't pay it. Here, the lender just pays the missing LLPA fee. No repurchase needed. And they can appeal this. But the serious ones are significant defects. These are big problems. They might lead to new pricing, or more often force the lender to repurchase the loan. What counts as significant? Things like major errors in underwriting the borrower's credit or the property's value, unacceptable loan terms like a super high LTV. And here's the absolute rule. Any loan involving fraudulent representations is always subject to repurchase.
Okay, fraud means automatic buyback.
Always. No wiggle room there.
Like
It really underscores why that initial underwriting and verification is so critical for the lender.
All right, so that's conforming loans, the ones that meet the GSE rules. What about conventional loans that don't? Those are non-conforming mortgages. Pretty simple. They either exceed the conforming loan limits or they fail to meet other GSE underwriting standards for some reason. You'll hear different terms used here. A jumbo loan is the most common. It just means the loan amount is above the conforming limit for that area. Simple as that. Historically, there were also Alta loans, kind of sitting between prime and subprime risk-wise, and subprime loans, which were higher interest loans for borrowers with poor credit history. And the term non-traditional mortgages covers anything other than a standard 30-year fixed-rate loan, as defined by the SAFE Act. Think interest-only, payment option ARMs. But remember, the ATR rule has really clamped down on features like negative amortization. It's now mostly prohibited unless the borrower can qualify based on fully amortizing payments, which makes those old risky products much rarer, a direct result of learning from the crisis.
Okay, let's shift gears completely now. We've covered conventional loans, both conforming and non-conforming. Now let's dive into the world of non-conventional or government loans. These are different because they have direct backing from a U.S. government agency. They're either insured or guaranteed. This government support often opens doors for borrowers who might not qualify for conventional loans, and it comes with unique features.
First up, probably the most well-known, FHA loans. Now, a common mix-up. The FHA Federal Housing Administration doesn't actually make the loans. Instead, FHA insures loans made by private lenders who are FHA approved. That insurance protects the lender if the borrower defaults. Big safety net for the lender. HUD, the Department of Housing and Urban Development, is the agency in charge of FHA. They issue policy updates through mortgagee letters, and everything gets compiled into the big rule book. HUD Handbook 4000.1. That's the Bible for FHA lending.
So why are FHA loans so popular? What are the key FHA loan characteristics? Well, the big draws are usually the low down payment options, the limits on closing costs borrowers can be charged, and generally more flexible underwriting compared to conventional, designed to help more people achieve homeownership. Now, the maximum mortgage amounts for FHA. This calculation is specific and testable. The FHA limit in any given area is the lesser of two numbers, either 115% of the median house price for that area or our 150% of the national conforming loan limit, $806,500 for 2025. Let's use that Raleigh example from your source. Median price, $499K. 115% of that is $573,850. 150% of the national conforming limit, $806,500, is $1,209,750. Which number is lower? The $573,850. So that's the max FHA loan in Raleigh. If someone asked for $620K, they'd be ineligible for FHA. You need to be comfortable with that lesser of calculation.
Okay, practice that one. Got it.
Definitely. For current loan limits, there's a national floor, $524,225 for one unit, and a ceiling, $1,209,750 for one unit, that apply depending on local home prices relative to the national limit. Underwriting. Lenders get an FHA case number through the FHA Connection Portal. FHA uses its own AUS, the FHA Total Scorecard, via SHA Catalyst system. Gives back an accept or a refer. Refer means manual underwriting is needed. And there's a direct endorsement DE program. This lets approved, experienced lenders underwrite and close FHA loans themselves without sending them to FHA first. Speeds things up.
Okay. And a defining feature of FHA loans, FHA Mortgage Insurance Premium, MIP. It's always required, unlike conventional PMI, which depends on LTV. This MIP feeds the Mutual Mortgage Insurance Fund, MMIF, which has to keep a 2% capital reserve ratio. It's the fund that pays out lender claims. Borrowers pay into it in two ways. First, the Upfront Mortgage Insurance Premium, UFMIP. Quote, 1.75% of the base loan amount. It's a one-time charge paid at closing. Big point. It can be financed into the loan amount.
Which helps with cash to close.
Exactly. Second, the Annual Mortgage Insurance Premium, MIP. This is paid monthly, baked into the regular mortgage payment. The percentage depends on the LTV, loan term, and base loan amount. Now, MIP cancellation. This changed for loans with case numbers on or after June 3, 2013. So listen closely. This is critical exam info. For loans where the original LTV was 90% or less, the MIP is paid for 11 years, then it cancels. But here's the part that trips people up for loans where the original LTV was greater than 90%. The MIP is paid for the full loan term.
For the life of the loan.
For the life of the loan. That distinction, 11 years versus full term, based purely on that original LTV being above or below 90%, is absolutely essential to nail down for your test.
Okay, let's get into the specifics of FHA down payment and credit score requirements. Direct qualification points, minimum down payment, 3.5% of the sales price or appraised value, whichever is less. That money can be the borrower's own funds or gift funds. But here's a key prohibition. Seller-funded down payment assistance. Not allowed for FHA. Remember that. Now, minimum FICO scores. These are hard thresholds. Quote, 580 or higher, eligible for the 3.5% down payment program. Quote, 500 to 579, required to make a down payment of at least 10%. Still possible, but needs more cash down. Quote, below 500, not eligible for an FHA loan, full stop. Those score tiers, 580 plus, 500, 579, below 500, and the down payments, 3.5% or 10%. Absolutely memorize those.
Okay, 580 is the magic number for 3.5% down.
That's the key threshold. And seller concessions for FHA, limited to 6% of the sales price. Note that's different from the tiered conventional limits, just a flat 6% cap for FHA. FHA also has several loan programs. Beyond the standard purchase, there's the cash-out refinance, letting homeowners borrow up to 80% LTV. The home equity conversion mortgage, HECM, that's FHA's reverse mortgage for seniors 62 plus, requires mandatory HUD counseling. And the streamline refinance. This is for existing FHA borrowers refinancing into a new FHA loan. Often has reduced underwriting, maybe no appraisal, but it requires a net tangible benefit, proof it actually helps the borrower, and there's a 210-day waiting period from the previous FHA closing. The details are in the handbook.
All right, from FHA insurance to VA guarantees, let's talk VA loans, backed by the U.S. Department of Veterans Affairs. Like FHA, the VA doesn't lend money directly. It guarantees a portion of the loan made by a private lender to an eligible veteran. That guarantee protects the lender if the veteran defaults.
And VA loans. They have some really powerful VA loan characteristics. The advantages are significant. Often, 100% financing, so zero down payment required, no prepayment penalties ever. Generally flexible underwriting, limits on closing costs, really strong benefits for veterans. A core concept is the loan guarantee, or entitlement. The VA doesn't cap the loan amount, but it limits how much it guarantees. Basic entitlement is $36,000. For loans over $144K, if the veteran has full entitlement available, the VA typically guarantees 25% of the loan amount. But if they've used some entitlement before, it gets more complex. Remember that calculation we walked through?
Yeah, the multi-step one with the conforming limit involved.
Exactly. Calculating 25% of the new loan, 25% of the conforming limit, subtracting used entitlement from that second number, and the VA guarantee is the lesser of the first result and the third result. The lesser of calculation with partial entitlement is complex. Definitely practice it. Origination. The veteran needs a certificate of eligibility. COE, to show they're eligible and how much entitlement they have. The lender gets a notice of value, NOV, from a VA-approved appraisal.
Okay, let's break down the fees specific to VA loans. First, the origination fee. Lenders can charge a flat fee, but, quote, no more than 1% of the loan amount. That's per 38 CFR, section 36.4313C. This 1% is meant to cover things like doc prep, escrow, settlement costs. There are other allowable fees veterans can be charged for, like their appraisal, recording fees, credit report, title insurance, the usual third-party stuff. Then there's the funding fee. This is unique to VA. It's non-refundable, paid by most veterans, not all, and it helps offset the program's cost to taxpayers. The percentage varies, depends on the down payment, if any, if it's their first time using the benefit, the loan type. The rates are in VA circulars, like 26, 2306. Super important exemption for the exam. Veterans with service-connected disabilities are exempt from the funding fee, don't have to pay it.
That's a key benefit.
Absolutely. And like the FHA UFMIP, this funding fee can be financed into the loan. Using that example, Julia, first-time use, 5% down on $232,500. Origination fee is 1%, $2,325. Funding fee is 1.50%, $3,487.50, and she can roll that into the loan. Know how the P percentage changes.
A few other VA loan details crucial for the exam. Debt-to-income DTI ratio. VA looks at a total DTI, aiming for generally 41% or less. But uniquely, VA heavily relies on a residual income analysis. This is critical. As the reg says, 38 CFR section 36.434DE, this calculates if the veteran has enough money left over after all debts and housing costs are paid to cover basic living expenses. That residual income piece is vital and specific to VA underwriting. Occupancy and assumability. The veteran must intend to occupy the property as their primary residence. And here's a standout feature. VA loans are assumable. A qualified buyer can take over the existing VA loan, and that buyer does not have to be a veteran.
Wow, anyone qualified can assume it.
Yes, if they qualify financially and the VA approves, that's a unique aspect compared to most conventional loans today.
Okay, one more government program to cover. USDRHS loans. These come from the U.S. Department of Agriculture's Rural Housing Service. Section 502 loans, their specific mission. Helping low to moderate income borrowers buy homes in eligible rural areas, focuses on rural development.
Right, and there are two main types of USDRH loans. First, RHS direct loans. These are actually funded by the government, directly to low and very low income borrowers. They can have subsidized interest rates, sometimes way down at 1%, and longer terms, maybe 33 or 38 years. Second, RHS guaranteed loans. These are funded by private lenders, like most loans, but the RHS guarantees them for low and moderate income borrowers. Terms are usually 30 years. Both types share some key USDRHS loan characteristics. The biggest benefit, both typically offer 100% financing, usually no down payment needed. Eligibility depends on meeting income limits, and the property being in a designated rural area, you can check eligibility maps online. All RHS loans must have a fixed interest rate, no IRMs here. And mortgage insurance. Direct loans generally don't have it. Guaranteed loans don't have traditional MI, but they do have two fees. An upfront guarantee fee, currently 1% of the loan amount can be financed, and an annual fee, currently 0.35% of the outstanding balance, paid monthly for the life of the loan. Here's a specific protection for borrowers you should know. If the lender is late paying that annual fee to USDA, they get hit with a 4% late charge. That charge cannot be passed on to the borrower. Key protection.
Okay, that wraps up the major loan program types. Now let's step back for some crucial historical context. Guidances on mortgage lending. You can't fully appreciate today's rules, like ATR and QM, without understanding the crisis that led to them, the subprime mortgage meltdown. In response, regulators issued guidances. Now, it's vital to remember these were initially not laws. They were strong recommendations, warnings, setting the stage for what later became mandatory regulations. They were the industry's wake-up call.
Exactly. One of the first big ones was the Guidance on Non-Traditional Mortgage Product Risks in 2006. It directly targeted those risky loan types that were everywhere. The interest-only loans, payment option ARMs, where balances could actually go up. It specifically discouraged things like making loans based only on the hope the property value would rise, collateral-dependent lending. Risk layering, like giving a risky loan type with weak documentation to a borrower with bad credit, and failing to clearly warn borrowers about potential payment shock or negative amortization.
Then, in 2007, as things were really getting bad, came the statement on subprime mortgage lending. This focused squarely on the risks of lending to subprime borrowers, and it actually helped define what that meant. A subprime borrower typically showed higher risk through things like 2 or more 30-day late payments in the past year, one or more 60-day lates in the past 2 years, a recent foreclosure, repo, or charge-off, bankruptcy in the past 5 years, low credit scores indicating high default risk, or very high DTI, maybe 50% or more. The statement specifically warned about the absolute riskiest combinations. ARM starting with super low teaser rates, especially if they had high rate caps, combined with weak income documentation and prepayment penalties, those were ticking time bombs.
And why does this history matter today? What's the relevance of the guidances today? Here's the critical connection for your exam. Many of the core principles and warnings from those guidances were later written into law by the Dodd-Frank Act. What was once just discouraged became illegal. For instance, it's now illegal to originate negative amortization loans without specific disclosures and counseling. Direct response. It's illegal to originate loans with prepayment penalties, except for certain non-higher price fixed-rate QMs. You can't finance single premium credit insurance into the loan. And most fundamentally, it is now absolutely illegal to make a residential mortgage without first making a reasonable, good faith determination that the borrower has the ability to repay based on verified information income, assets, debts, DTI, employment. That's the ATR rule in action. It shows a clear path from crisis to guidance to binding regulation, all aimed at preventing a repeat.
Perfect context. Okay, just before we wrap up, a quick mention of the most basic type. Fixed rate loans. Simple concept. The interest rate is set at closing, doesn't change for the whole loan term. Predictable payments. Most common terms are 15 and 30 years. One specific thing to note. Fannie and Freddie do buy conventional loans with only 3% down those 97% LTV loans, but under specific conditions. The interest rate has to be fixed, the term can't be longer than 30 years, and it has to be for a first-time home buyer buying their primary residence. So low down payment fixed rates are possible conventionally. And of course, non-conventional fixed rate loans exist too. FHA offers 15 and 30-year fixed, sometimes 2025. VA offers 15, 20, 25, and 30-year fixed. It's a foundational product across the board. Okay, here's where it really clicks, right? We have covered a ton of ground today, from the absolute foundation ability to repay through all the details of qualified mortgages, the types, the features, the underwriting, those critical fee thresholds. Then we navigated conventional loans, conforming versus non-conforming, LLPAs, repurchases, and we dove deep into the government-backed options. FHA, VA, USD, RHS, nailing down their unique rules for insurance, guarantees, fees, and eligibility. We even looked back at the history, the guidances that led us here. For your safe exam, remember, precision is everything if you want that perfect score. You now have the exact details, the verbatim definitions where needed, the critical distinctions, everything required to tackle those questions with confidence. Remember the tiers, remember the exceptions, remember the definitions.
And as you keep studying, maybe think about this. This whole evolution we've discussed, right? From the Wild West to guidances to these super strict QM rules and detailed government programs. How does that reflect this ongoing tug of war between making credit available and protecting consumers? Picture this scenario. A borrower, maybe self-employed, just misses qualifying for a conventional QM because their documented DTI is a point too high. How do FHA, or maybe even VA, with their different underwriting approaches like residual income for VA, suddenly become absolutely vital pathways for that person to actually buy a home? Understanding not just the rules, but why they exist and how they interact. That doesn't just get you points on the test. It makes you a genuinely better, more knowledgeable loan officer who can actually guide clients effectively through this maze.
So what does this all mean for you right now? It means you're building that solid, connected foundation for success, not just for the test, but for your career. Keep running those calculations, keep reviewing those specific thresholds, 3%, 6%, 9% concessions, 3.5% down, or FHA MIP cancellation rules, and always ask why. Why does this rule exist? Understanding the why makes the what stick so much better. We'll be back soon with another deep dive to keep you sharp and ready. Keep up the great work.